Welcome back, my awesome people. In today's episode, I am excited to announce that I sold my Evolve FANGMA ETF, ticker symbol TECH.TO, after holding it for almost 2 years. So before you give me that weird look like who celebrates selling a stock, hey, selling a stock is always calling for a celebration. Now, this episode is strictly going to be coming from my opinion and personal experiences with this ETF. So if you are looking for me to sell you on this ETF or push it to my viewers as a pump and dump, you are so wrong. So let's get right into it. So this ETF was created back in May of 2021 by Evolve, which manages over $6.5 billion under management. And so I bought this ETF back in the fall of 2021 for about $11 per share. Now, if you are wondering why I bought this stock, well, here was my thinking. This ETF holds the top 6 tech stocks of that time: Apple, Google, Netflix, Microsoft, Facebook, which is now Meta, and Alphabet. And each one is almost equally weighted in the ETF. Now, this ETF pays almost nothing in dividends. I was getting about 16 cents per month for owning about 101 shares at an average price of $11. So for about $1,000 worth of shares, I got 16 cents a month in dividends. So in total, I got about $2.88 for holding it for 18 months. Better than nothing, right? Well, for me, this was not a dividend play, but instead a growth play. And as you, my awesome people, know, I am a heavy long-term dividend investor, where my portfolio is about 80% long-term dividend and the rest is for growth and riskier stocks. So using my ingenious brain, I figured that you cannot beat the tech sector. They will always be winners. Now, hear me out. This was during the tech surge as everyone was working from home. And so tech companies, big and small, old and new, were strengthened by this work from home society. But once work from home protocols were gone and people started going back to the office, guess what happened? Tech companies that were soaring in the hundreds of percents were now falling in the hundreds of percents. And I was not that stupid to take the kind of risk with very risky, trendy companies that were popping out of nowhere through SPACs and acquisitions during that time. I was very conservative and chose to invest in the big tech companies that have not only been around for a while, but were also heavily going into AI and the multiverse, which is going to be our future soon. I knew I could not go wrong with Apple, Google, Facebook, Alphabet, and Microsoft, as they pretty much control the digital world. And Netflix, it's the newer tech giant. It was just thrown in there in the ETF, I'm guessing, as I was mostly interested in having one ETF that only cost $11 a share, but gave me the exposure to the top tech companies of the world. So I jumped in, and for a few months, I was doing pretty good. In about a month or so, it went from $11 a share to $13 a share. So I had hope that it would continue this upward trend for a little bit longer. I knew it had to fall eventually and then come back strong. But I was so wrong. Many investors were also so wrong. Tech as a whole started falling. Netflix missed its earnings in the winter of 2022, which began the massive sell-off in the tech sector as a whole. That is how bad Netflix's earnings were. It revealed that Netflix had massive subscriber decline with minimal growth in the future. This was also around the same time that many companies were forcing their workers to come back to the office. So this chaos of tech uncertainty and with workers going back to the office, this caused this ETF to plummet by more than 40%. And at this point, I have only been holding it for less than 6 months. And the ETF started sitting at $6 to $7 for a while. But recently, especially with the crazy run by NVIDIA, it actually helped the overall tech sector. Within 6 months of this year, my ETF went from $6 to $7 a share to right back to $11 a share. So I was finally in the green, even though I have been itching to get out of this ETF because I knew that the money could have been used for a better investment instead of sitting in a stock or ETF, I should say, that doesn't pay any dividends and that has been flat for over a year. So even though I was in the green, I did watch it for a bit longer just to see what the tech sector was going to do. And unfortunately, the tech sector is ready for another massive decline. So I decided to pull out before the decline. So how much profit did I make off of this? Well, I only made 2.4% profit with $2.88 of dividends in total over 18 months. Pretty shitty deal, I would say. But I learned a very, very valuable lesson. And that is growth stocks with no dividends suck and is a waste of valuable time for your hard-earned money to just sit around hoping it will jump when you can instead sit back, relax, and collect monthly dividend payments regardless of what the stock price is doing. So I cashed out and dumped it all into ETHY and BTCY, my two favorite monthly dividend paying crypto ETFs, as it is currently paying a 14% yield without ever owning any crypto coins or staking. So Jacob Rant, now that you have sold your Evolve Fangman ETF, what now? Well, the recession that was feared months ago is finally happening. Debt is at an all-time high. Inflation is creeping up again, and countries may soon go back to masking and lockdowns. And earnings season is around the corner. With all these negatives, it will surely cause people to not spend their money. And if people are not spending by buying products or services, then companies will surely have a below par upcoming earnings season this fall, which will result in a declining and flat market for a while. So this holiday season will definitely be an interesting one. And for those wondering why I think the tech sector is headed for another dark time, is because of these three reasons. Reason number one, the monopoly. If NVIDIA falls hard, it will take the tech sector with it. If Apple falls hard, it will take the tech sector with it. The tech sector is too big to fail, but it is also too big that it can make others fail, because these companies are literally interconnected and rely on each other. So if one goes down, they all seem to follow. NVIDIA is not even one of the companies that is held in this ETF, yet its downfall and its jump was greatly felt in this ETF. So thank you, NVIDIA. So just watch out with the tech sector, because their monopoly has a massive ripple effect in many, many other companies. Reason number two, NVIDIA is way overvalued, as it is valued at over 200x, and Apple's iPhone production is 97% coming from China. So the two biggest tech companies are simply not in a position to make big moves, as many investors are seeing through the money and what is really happening. NVIDIA CEO Jensen Huang sold over $42 million worth of shares between September 1st and September 6th. Even though NVIDIA is doing great financially, as it is being on track to double its quarterly revenue, NVIDIA insiders haven't purchased a single share in the past 12 months. But instead, in June and August, NVIDIA's director Mark Stevens sold $75 million worth of his NVIDIA shares. Not all investors are convinced that NVIDIA can go any higher, and many believe that NVIDIA is a bubble and that bubble is likely to pop. Regardless of the negative talk, which I did base my decision to sell my ETF, NVIDIA stock has totally dominated this year, as it has returned over 220% to its investors year to date. As the director and the CEO of one of the largest tech companies in the world have begun to sell their shares, they definitely know what it is to come this fall in the stock market. And this is what's currently happening with Apple, which leads me to reason number three. Apple is going through through some wild shit right now with China. China's government has reportedly expanded its ban of iPhones to local government workers and state-owned companies. The ban on the use of Apple products is believed to be a sign of China pushing back on its reliance on US technology. China has more than 150,000 state-owned companies employing more than 56 million people. Whew, that is a lot of iPhones. And in response to the news, Apple shares fell more than 10% since China's ban, as China is one of Apple's biggest markets and generates nearly a fifth of its revenue. And Apple's production still remains in China. Like, get out of China, get out! With about 95% of Apple products made in China. The rising tension in China has put Apple in the middle, and it is looking like a corporate proxy war between China and the United States, and Apple, unfortunately, is in the middle of it. It also doesn't help that China has slowly been moving its facilities to India, as India has welcomed Apple with open arms. And this problem that Apple is having is just the beginning for tech companies and even American companies that operate out of China. Apple has found itself the latest tech industry victim of geopolitical tensions between the US and China. And with these global factors having a major impact on US-based tech companies and their production, this could be the beginning of the end for many tech companies as a whole. So, with all these problems that the tech sector is going to face soon in and outside of America, I would rather just pull out of the tech sector while it is in the green, even if it was just a 2% profit, instead of sitting on it with the possibility of it falling and me waiting another year or two for it to come right back up. And it's not like this ETF pays a dividend. If it paid a dividend, a very nice dividend, I wouldn't mind waiting. However, because it pays such a shit dividend, I am not waiting. So I sold. So if you are still in the Evolve Fragment ETF, ticker symbol TECH.TO, then it is totally up to you to stay in. But get out if you can, because it is not worth the wait, especially since it doesn't even pay a decent dividend. Why have your money tied up, right? And remember, my awesome people, just like all the information that I put in my videos, please assess your risk appetite, always diversify, and do your own due diligence, because I am just a clown on YouTube. Stay ranting.